Good afternoon. It's John Mousseau. I'm the CEO of Cumberland Advisors. It is Friday afternoon, a little after 1 o'clock on March 26th. I'm also subbing for my colleague Matt McAleer, who's getting a well-deserved day off. A little bit about bonds first. 10-year bond, 165, 30-year bond, 236, both down about 8 basis points this week in yield. It's a little bit of backing and filling because we've seen yields go up fairly decently the last few weeks. So this is a little coalescing. We think it probably has more to go, but think about it as another step in the return to normalcy. Equity markets this week, pretty muted. Dow and S&P up a little bit. NASDAQ off 1% and change as of we sit here now. What is this? This is really the equity markets catching up with themselves before we think moving to higher ground. The equity markets have come a long way. So now it's like, okay, a little bit of backing and filling, dealing with the fact that we're a little bit higher interest rates, which is what you would expect as the market comes out again of the deep trough that we were in and continues to improve, and the economy improves as we all get vaccinated. A couple of pieces of good news this week when you look at that. Number one, we saw initial jobless claims down below 700,000, which at that level is higher than you ever saw back in the Great Recession of 08-09, but clearly has worked its way down from very, very high numbers that we saw last year. So we see that as a good sign, and hopefully more jobs are being created than people are going for initial jobless claims, and we think we're turning that corner very soon. Another piece of good news was the University of Michigan consumer confidence. That came out today. The index was at 85. That is very high. It had bottomed out at around 71 or so last April after the devastating March that we'd had with the slide in oil and the slide in markets and the rapid uptick in COVID. So we think that those two combined are very good signs that things are improving. When you think about the Fed, has made note out there that they're going to keep short-term interest rates low. We think that's true. We've talked about the bond market kind of being, as a horse, a little untethered, will do what it wants to do. But remember, yields which have moved up are only returning back to normal. And so you basically have a 30-year bond that's essentially where you were at the beginning of 2020, and a 10-year bond that's about 25 basis points lower than it was at the beginning of 2020. We think, again, there's more return to normal there too. So we'll catch up with you next week. We hope you have a great weekend, and thanks for tuning in.